Tax Act in 2017 made major changes into the tax law, but it was not permanent. Sunset supposed to happen as of January 1st, 2026, a little bit over a year ago. And today we will examine what it means to us, what we need to be on the lookout, and what potential tax savings opportunity might exist before the sunset is happening. So we have about a year and a half till the event. However, it is possible that the legislative environment will change after this presidential election. And we'll talk about what we should expect in that on that front as well. I'll share with you some numbers, some ideas. We will spend quite a bit of time talking about estate planning because estate planning exclusions also changing, and it's a big change with the sunset. So we will talk about that as well. Estate planning decisions generally affect those that come after us, all our beneficiaries, our children, grandchildren, people we love, charities. So when Congress enacted an estate tax exclusion increase, it was a significant change how people gift money to others. And we will take a look at the difference and see what it means to us. So let's talk about the sunset. So sunset happened to let the TCJA, so Tax Act, expire as of January 1st, 2026. And what will expire is this very large federal estate and gift tax exemption amounts. So currently you can see on the right side that effective January this year, the exclusion amount for estate tax purposes on the federal level is 12.92 million. It came from 12.92 million to 13.61 million, which was an increase of $690,000. So that increase is only applicable to one person. When you double this amount, family of two, husband and wife, can exclude from their estate $27.2 million. So what this law have done is pretty much made 98% of population of the United States not subject to estate taxes. And that's a huge deal because previously the numbers were by far lower. And now pretty much all people, a lot of people will not be paying estate tax. And that's a big relief. However, once we experience a sunset, if there is no legislation changes occur, then that number will go down. And I'll show you the trajectory that how numbers increased and how they will go down. There are also some standard deductions, itemized deductions, personal exemptions items that will change, and they will revert back to pre-TCJA levels. That's also very significant. If you remember, a lot of Californians know that this act also passed a cap on salt taxes, state and income tax deduction. We used to be able to deduct our entire state and income tax without limitations. What happened in 2018 that we have only $10,000 as a standard deduction, part of the standard deduction. So it's a very small number compared to our property tax and income tax we're paying in California. The states that were affected the most by that was California, New York State, because they are the highest earners and also the highest property values experiencing on both East Coast and West Coast. So that's supposed to sunset, and we'll talk about each candidate into presidency, talking about that differently, and I will share with you some ideas on that front as well. So let's understand estate taxes and the gift taxes a little bit more so we can make a better decision how we can take advantage of it and what we can do in the next year and a few months. So first of all, federal estate tax is applied only to the amount of money that's above the exclusion amount. Simply stating, if, example, your estate is $15 million and you're a single person and you to pass this year, then your estate that's subject to estate taxes will be in the amount of $2 million. And 40% of it will be tax levied on that money. So 40% of $2 million will go to our IRS, and your estate has 9 months to make the payment. So you have to have enough liquidity, means cash, to make the payment, and it's a very sizable, it's a very, very large amount of money, that $400,000 plus. By the way, state of California does not have estate taxes, but not all states are like that. There's a few states in this country that have their own estate taxes, their own inheritance tax. Washington State is one of them. Even though they don't have state tax, they do have their own estate tax. And you need to be very careful if you move into state of Washington because it's cheaper, you don't have to pay state tax. You definitely need to look into if you'll be subject to estate taxes. Now let's talk about federal gift tax. That's a different thing. It's not an estate. It's not all your entire net worth. By the way, what goes into your estate? It goes all the real estate. It goes business values, your IRA, your non-retirement assets, your royalties, everything that has the value will be part of your estate. Federal gift tax works differently. You are allowed to gift away in 2024 $18 million per person per beneficiary. So one person can give $18,000 to as many beneficiaries as they wish. So it could be unlimited number of beneficiaries. As long as you're giving $18,000 to each person, you're not utilizing or using up your federal estate tax exclusion, which we just talked about, $30 million. What if you decide to give away $1 million this year? So you will not be subject to any taxation, but your lifetime federal estate exclusion of $13 million will be reduced by $1 million less $18,000. So we need to be mindful. And also, you'll be prompted to file Form 709 that informs IRS that you made a gift that's over the federal gift tax exclusion amount. So there is two things, as federal gift tax exclusion and estate tax exclusion, which is much larger than a gift tax. Another point to make that some families decide that the kids doing well, we don't need to give them money, we will give money to grandkids, and hoping that they will skip the estate tax. Unfortunately, it doesn't work that way. The generation skipping tax works very similarly to regular estate tax. It just applied to grandchildren. So if you decide to give grandchildren money over $18,000 per beneficiary, then you will be using up your exclusion, lifetime exclusion amount as well. So there is no way to avoid that, unfortunately. A lot of people considering now, because of such a large personal federal exclusion amount for estate taxes, to give a large amount of money, used up their sizable exclusion before it runs out, so that you can preserve it. Because once you give it away, and current legislation allows you to do it without paying any estate tax, this will be grandfathered. It's not going to be taken away from you, but you need to be in a very higher estate brackets in order to make sense out of it. Otherwise, it doesn't, right? Given a lot of big sums of money, you need to make sure that you can afford it and you have enough your own capital later on to survive and sustain yourself on. Another very good change that came along is deceased spouses now, the first to die, has something called portability rule. The portability, where, give you an example, let's say it's a second marriage and husband has a small estate, wife has a larger estate, and husband passed away first, and he did not use up all of his $13 million. Let's say he used up 5. So the remaining $8 million will be ported to wife. So wife now has, as of today's law stands, $13 million plus another 8. So she has $21 million to claim against her estate. So that portability exists and you are eligible only if you file estate tax return on a deceased person. If you don't do it within 2 years, that portability is gone. So you need to be, even if you're not certain that your estate is subject to estate tax in the future, but you're getting close to it maybe by age of 85 or 90, it makes sense when first spouses to file to capture that portability and ability for you to carry on unused exclusion amount, especially such a large number. Any questions? I know it's a very, technically heavy material, so I just want to make sure that everybody with me and you're comfortable with the material. Today, we will also talk about how other taxes will change with the sunset. Not only estate taxes change, also you can see here one of the considerations that federal income tax brackets also will go up. So they'll go down and your tax will go up. You can see here on the chart that this is your current brackets. That's a column number 3. And this is at sunset, the bracket changes. So the people who will be affected the most by the bracket, but people that make pretty much between 44,000 all the way till 300,000. So the biggest increase goes to folks who make over $200,000 married filing jointly, all the way to 360. So if that's the case, you need to start planning. What can you do to lower your taxes? If your tax bracket today is low and you know it's going to increase in the future, either due to sunset or due to further income in your family, then you can consider Roth conversions. If you convert money from IRA to Roth and you pay lower income tax or lower effective tax rate, that it makes sense to do certain conversions. Also remember that conversions only needs to be done by end of the year, by December. If you have not completed conversion by December 31st, you cannot retroactively do it in the following year. It's in a contrast with IRA contributions that goes all the way till April next year. Conversions have to happen within the same calendar year. And conversions is a great way to reduce your overall required minimum distributions from IRA. It's also a great way for you to accrue some income in the years when your income is very low, but the amount of conversion has to be very seriously considered, not to increase to the level where it does not make sense because your current tax bracket now is much higher than in the future years. So Roth conversions is a great opportunity, but it also depends on your income in the next at least 5 years. You need to take a look. Consideration number 2. Unless Congress passes a new legislation, a state and gift tax exemption amount will decrease, and it will decrease significantly. You've see here on the chart, then there is the historical numbers all the way to 2004 to show what was the exclusion amount then. It was only $2 million. Then it went down even further from 2006 to 2008, and then we had a bump. The highest number was achieved by the act we're talking about that will be sunsetting. So 2018, it's doubled. It went to $11.1 million, and each year it's adjusted by inflation rate. So you can see that 2023, it was $12.9 million. Now it's 13.2. In 2026, it will be back to $6.4 million. So pretty much pre-act numbers, a little bit inflated. Largest state exclusion ever we've seen, and we probably will not see this number again, because estate taxes are the easiest way to reduce the budget deficit. It happens on the second death. Beneficiaries cannot do much about it, so it's usually applied to largest estates, and estate tax avoidance is very difficult. It's impossible to plan for it. A couple years before person passes, it needs to be done 10-20 years before in order for it to be effective. So something to think about, especially for those people who are having an estate over exclusion amount today or getting close. You need to seriously talk about it. I had a meeting today with some of my clients. We were looking into opportunities, what exists right now. There is several ways to approach it. You can have 529 plans that you can overfund. We'll talk about it. There's a few other options I will share with you. We can see how we can reduce your estate to avoid to shift your assets from you to your heirs sooner than later. So all appreciation will be happening outside of your estate. Evergreen gifting strategies, and one of them is making $18,000 contribution toward either 529 or directly to your children or grandchildren will allow you not to use up your exclusion amount, but consistently reduce your estate by making certain gifts. And gift has to be irrevocable, because if it's in a joint account, it's not a gift. It has to go into a beneficiary account, and you cannot be on their account. But it's a great way for you to shift some income. Another consideration, we'll talk about it in greater details, is 529 planning opportunities. A lot of people don't like to put money in 529 because they're afraid that their children or grandchildren will not qualify for financial aid or any other type of aid. But I have to tell you that recently in 2024, there is a new law passed allowing grandparents to make contributions without considerations, without the ability to make grandchildren ineligible for financial aid, for need-based aid. So now grandchildren can be an owners of 529 with a sizable 529 accounts, and grandchildren will be beneficiaries, and there is no effect on how much financial aid the grandkids will get based on grandparents' 529 account balances. So that's a great win, and those who are considering the strategy now shouldn't worry about disqualifying children from the aid. Amount of money that can go into 529 plan is the same as your gift with $18,000, but you can pre-funded it. You can fund it with $18,000 times 5 years in 1 year, and then you will not make any contributions anymore. But once you make a contribution into 529, all that money grows tax-free as long as the beneficiary withdraw the money for qualified educational expenses. It's a great tool. Lately, there's been a lot of good plans developed, which is very inexpensive, easy to manage, and grandchildren can use this money for any kind of educational expenses. It doesn't have to be graduate, postgraduate, or it doesn't have to be college. It could also be a private school. It could be a middle school, high school, elementary school. It's a great way to help your kids to raise your grandkids. Another one that I will mention briefly, if you pay qualified tuition and medical expenses directly to the medical organization or college or school of an institution of that sort, you are not bound to $18,000 limit. You can make directly payment as much as you want or can, and it will not be counted toward your $18,000 gift exclusion. But you need to make the payment directly to them. It cannot go to your kids or grandkids. Maximizing gifted and to qualified charities. A lot of people who are charitably inclined making contributions to charity, and there is a difference between making a cash contribution, which capped at 60% of your AGI becomes deductible. If you're making a contribution with the in-kind, means securities or property, then your income tax deduction is up to 30% of your adjusted gross income without any capital gains. So you need to consider, you need to work with your financial advisor and use with tax person to see what amount makes sense. What should I be contributing? Also, when you make a contribution to a charity in the amount of securities, and instead of you selling them, the charity will sell them. You pay no capital gain tax, and they pay no capital gain tax because they excluded from taxation. So it's a win-win situation. So giving certain amount of money directly in kind to charity makes a lot of sense. Once you reach certain age, which is 70 and a half, you're eligible to make qualified charitable distribution. And as long as it go into a qualified charity, you're not taxed on it. Amount of contribution can go up to $100,000 withdrawal in 1 year. And as long as it go into a qualified charitable organization, there is no income tax withheld on that distribution. Another wonderful way of making a contribution is to establish a donor advice fund. We call it DAF. Donor advice fund is established at a financial institution like a regular investment accounts, and you make a large sum of contribution in 1 year. Once, especially, it's good to make it in a year where you have a very high income. Maybe you sold the business, you sold something that has a lot of ordinary income. Then you can deduct all of that you made into that DAF account against that income. And you are not obligated to distribute that amount to the charity immediately. You can actually allocate different amount of money through different times to different charitable organizations, but you get deductions immediately in 1 year. And then over the course of your lifetime, you can start gifting it to different charity directly from that account. But the tax deduction you get immediately. Gifting through various charitable trusts is also another idea. A lot of charitable trusts require separate administration, separate tax ID, so it's more complicated. There might be a need for it, but it needs to be carefully considered, so because it's much more difficult to administer and requires a lot of more management. If you fall into one of these 3 wealth profiles, consider gifting strategies. So if you're a estate, you're a single person, you're a estate of over $3 million, over time, and with you, most likely that, especially if we are going back to sunset limits, your rate of return, if you're making at least 3 to 4%, you will experience a huge increase in your overall net worth. Even with this 3% rate of return that shows here on the right, it will take you 23 years to get to a $6 million exclusion amount, right? And everything over $6 million will be taxable. If your rate of return is 4%, it takes only 17 years for you to double your money and as a result get to your exclusion amount from estate taxes. If you're mostly a stock investor and you're making 7% annual return, which a reasonable number, we do it for clients, then it takes only 10 years. So potentially you can be subject to estate taxes 10 years from now if you have a very nice growth rate of your portfolio and your other assets. So once you're at over $3 million, some gifting strategy, minor, not very big amounts, needs to be considered. If your estate falls between $6 million and $12 million, then your situation is much more complex, and now you need to employ different strategy. Maybe you need to employ, besides just gifting $18,000 a year to your children and grandchildren, you need to start doing dollar advice funds if you are charitably inclined, or you're considering 529, or you're paying directly to financial institutions on behalf of your children, or medical bills for your family members. You can also look into establishing something called grantor retained annuity trust, which we can cover in some details toward the end if we have time. You can also consider irrevocable life insurance trust. We call it ILIT. And ILIT is the way for you to bring the money back into your estate after estate taxes are due and pass it to your beneficiaries estate tax-free, because once money is sitting in a life insurance policy, they will not be brought back to your estate if they're owned by this ILIT trust. So there is various ways to do it. Once your estate is over a certain dollar amount, maybe $12 million per person plus, then the more complicated strategies needs to be done. And you need to work with your financial advisor who is familiar with the ways estate planning works, and closely with your estate attorney. So maybe a team approach would be the most beneficial, because then you can see the financial implications of the strategy, and also your estate attorney can explain to you the legal part of it. But the more assets you have, the more complicated, unfortunately or fortunately, approach becomes. I just would like to check if there is any questions. If not, we will move on. Somebody asked, do qualified charitable distributions from IRA tax deductible as a charitable donation? Great question. The answer is not, because you cannot double dip. You cannot double dip. The double dipping basically means that if you already taking money from your IRA and IRS is not taxing you on that, you can deduct it, right? Because you either do a regular charitable contribution, and it's going to be tax deductible based on your AGI. So there are some AGI limits. We just talked about it. Maybe I can go back and show you. Give me a second. So we can look at the deduction. You can see here 60% on cash, up to your 60% of AGI limit, and also 30% if it's a security. But when you take money and give it to charitable organizations directly from your IRA, then you can see it's at the 0.1 to a third on the consideration 6. And that one allow you to take money from IRA directly without reporting that distribution as a taxable income. So you immediately get tax deduction. You need to keep a track of it because IRS does not, and you will get issued 1099-R stating that you made a contribution, and it would be your responsibility to prove to IRS that you actually made a contribution to qualified charity. The amount of contribution that goes to charitable organization cannot exceed more than $100,000 in one given year.
Mike has a follow-up to that, Larysa.
Sure.
Yeah, he's asking if the charitable remainder trust is the same as a donor-advised fund.
Wonderful question also. So charitable remainder trust is different, and I will explain the difference. So DAF is a donor advised fund. So let's imagine that I decided that I want, let's say I'm selling a business and I want to reduce how much taxes I want to pay. And I know that over the course of my lifetime, I would like to make a contribution of $200,000, but it's going to take me years to do, right? I'm going to make $10,000 today, $15,000 next year, but I don't know who will need the money and how much I'm going to give it to each charity. So what I'll do is I will open a donor advised fund. It's an investment account that Fidelity can open. We do that also. Schwab, anybody can open, really, like literally everybody has this type of accounts you can open. And once you open it, I'm going to fund it with $200,000 from the sales proceeds of my business. That reduces my income tax immediately, same year. And then I will take my time to write checks out of this account to different charity of my choice. I will write some amount this year, other amount next year, and I'll spend next 20 years donating from this account. Another benefit of having this type of account, this account will grow, which means you can actually give to charity more because this money is still invested, but you're getting a tax deduction today. Now, charitable remainder trust is completely different. If we're talking about grant or retained annuity trust, or charitable remainder trust, it's all based on annuity payments. So basically the way it works in a nutshell, it's a little bit more complicated in the details, but in a nutshell is you take a lump sum and you put it in this particular trust. Let's say it's a charitable remainder trust, right? The charity gets the full amount, you get tax deduction, and then you get the payment for life. And whatever remaining is left after all the payments are made to you and the charitable remainder trust ceases, that the difference will go to the charity. But you're getting the full deduction now for that amount. And that could be very significant. But the good news is you're not parting with your money completely because you're getting a little bit of income from that trust over the years, and then the remainder will go to your charitable organization. Very good question. It's difficult to identify the difference. I wanted to bring up it's more like a conversation point, not necessarily an educational. Right now we're seeing a different tax law proposals from different parties, and I'm evaluating one or the other, and it's very interesting to see if you look at different summaries that coming out legislatively, which party is proposing what? And recently I've heard that the Republican Party is proposing to remove the SALT deduction. So basically they're saying, if sunset happens, we will make sure that the SALT is removed. There might be some other changes. For Californians, it's a big deal. And the Democrats also proposing a higher tax credits. They're proposing a little bit higher tax on income over $400,000. So they want to tax the wealthy, but they are giving more benefits to those middle class people. So there are different parts. It's difficult to evaluate, but I encourage you to look into that, because it might also affect, your decision, how you, view this tax act, and I'll let you understand it a little bit more. That this tax act helped one people, but it definitely didn't help the Californians because of that cap on the SALT exclusion. It really erased a lot of itemized deduction opportunities for people, and a lot of people doing standard deduction because of that, because we don't have an ability to deduct entire state taxes. We're paying a lot of state tax and also property tax. So unless you lived in your property for 20 years, most likely your property tax are higher than $10,000, right? So this SALT proposition is extremely important, and would be interesting to see how it unfolds. And if it actually becomes if it goes back to a pre-act legislative change, it would be an excellent move for Californians. Any other questions? Anything else that we want to focus on? No, okay. I also want to bring up a couple of other ideas that I've seen my clients do, and potentially it can be some food for thoughts for you. Some of the people who are not certain that whether they will go over the exclusion amount or not, I advise to take your time a little bit for the next 6 months to see what the new legislative environment would look like. And you probably will see it after New Year, after we have an election, and after we start seeing the new potential law forming up, probably by the latest fall next year. I think it's going to be sooner than that. You will see which way it goes, one or the other. And if you are on the brink of the seeing that your estate taxes potentially can be taxable, especially 10 years from now, right? And your life expectancy at least 20, then you might want to act before you have this higher gift exclusion going away, higher state tax exclusion going away. But if you're below the $3 million threshold, do not rush to make any decisions, because if you are over gifting and you're not subject to estate tax, it is better to wait. So you have more control and more assets. Especially, you should not gift your primary residence to, or any, in fact, any highly appreciated asset. Because if you gift it today to anybody, that person who is receiving a gift will get your basis. So let's say I gift a highly appreciated stock, let's say Apple stock, to my friend or to my sister. She will carry the same cost basis as I am. So if my cost basis in stock is $20, her cost basis will be $20. That means that if she sells it, she's going to pay $180 per share gain. In contrast, if my shares are inherited, the person passed away and the money goes, the shares goes to another person as an inheritance, that person gets the full step up in basis. And a huge difference, which means if that person to sell the shares later on in life, then they carry zero tax liability. Let's say they inherited at a $200 per share, and they sold at $210. Only $10 per share is subject to taxation. And if you sell that within 1 year, $10 is ordinary income tax rate. If you sell it after 1 year, 1 day, it's a long-term capital tax rate, which most likely 15% flat. So you need to be very considerate. That's why when parents want to, and I hear it all the time, parents come to me and say, you know, I really want to help my kid. I have 2 properties. I'm going to move it to smaller one, give the larger money to my kids. They have 3 kids on their own. My grandkids need space. Once you change the title, your children will carry your low-cost basis on the property. It's not a good idea. Or if you as a parent selling your property and paying all the capital gain, you only do it when you must, but you have a chance to preserve that step-up opportunity upon death. That's the best way to approach it for the future. Otherwise, either you, if you sell it, or your heirs will pay a lot of tax if you're gifting them that property outright today. So they can live in your property, just don't change the title. Changing title from your name to joint name, let's say tenants in common, also does not help, because then they're 50% owners. Let's say you change it, you're 50% owner, they're 50% owner. It doesn't help them, because whatever is gifted to them does not get step up in basis after death. Another consideration that, and everybody who's on this call and potentially been married for the long time and also never checked the title of their property for the long time, please do. I have 2 cases in the last 3 years where the husband passed away and the property was not a community property with right of survivorship. It was joint tenancy. Because long time ago, people were advised, yeah, this is the best title, just keep it that way. Guess what? After husband passed away, and then wife stays in the house, and then she sells it, his portion does not get, it got frozen at the time when he passed away. So all appreciation on his portion is subject to taxation. There is a way to get out of it, but you have to write a letter to IRS, utilizing a tax attorney services. So it's a lot of hassle, and nobody knows if IRS will grant it. So titling your property, especially your real property, is extremely important, and will dictate what kind of taxes you or your heirs will pay end of the day. So be very careful about this kind of gifting. Every time you gift something more than $80,000 worth, what do you need to do? Well, you need to file 709, right? And tell the IRS that you made a gift over the exclusion amount. So they will take that amount out of your lifetime exclusion for estate taxes. So that's very important. So every time there is a change of a title, you need to be very careful about that. Any other questions?
There are some questions, Larysa.
No questions?
Yeah, there are some.
Okay, please.
Okay, in order to take advantage of the current higher estate tax exclusion amount, somebody asked that they understand that there's an irrevocable trust you can fund to remove assets from your estate. What is this trust called?
When you fund irrevocable trust, there is at least a handful of different type of irrevocable trust. One of them I mentioned, it's called irrevocable life insurance trust. And that has its own definition, where you you make a gift of your premium that you pay into life insurance into the ILIT. Let's call it ILIT, Irrevocable Life Insurance Trust. And ILIT will collect your gift into that entity and make a premium payments to insurance company for the life insurance it carries on your life. Let's say you buy a $5 million policy, right? Irrevocably, you made a gift into the trust. Every year you're doing it, and you're maintaining this policy. When the person passes away, that life insurance proceeds are not going back to your estate, because you do not own it. It goes directly to beneficiary, estate, and income tax free. So that's one type of irrevocable trust that utilizes life insurance proceeds. Another irrevocable life insurance trust would be a trust where you set up something, just regular trust, but you name your children as the trustees. You cannot be a trustee. It cannot be an arm's length transaction. You need to be completely removing your control over these assets. You put $1 million into trust. That's an Apple stock. You tell the kids, you know, the stock will probably double by the time I'm gone. So I want you to manage this irrevocable trust. and I have no control over it. And then whatever appreciation happens in the trust, the money doubles. Then when you pass these assets are not going back into your estate. They're already outside of your estate. The biggest benefit of this trust is that you removed all the appreciation of your Apple stock as of 2024 for the next 20 years out of your estate. So there is no estate taxes due on that money. But if you put $1 million, what will happen? You have to reduce your lifetime exclusion amount. But because it's so large today, it's advantageous to do. And I can talk and talk and talk. There are so many trusts. So I'll leave more to the end.
Okay, thanks.
Any other questions?
That's it so far.
Okay, so I'll talk to you about one more, which makes a lot of sense in Bay Area because we have a very highly appreciated real estate here. It's called QPERT. QPERT is where you gift your property into irrevocable trust, and you stay in your property rent-free, even though it's not your property, you stay in that. And property will appreciate over the years, we know that. And you have a specific timeline how long this trust will last, the trust who owns now your property. So all appreciation while we're waiting for that term to end, maybe 20 years, everything that at the end of year 20, when your trust ceases to exist, all the value of that appreciation will go to kids tax-free. But if you pass away within the 20 years, this property is brought back into your estate. So you kind of need to watch. It's difficult to know, right? We never know. But you need to watch for the term of the trust and how highly appreciated this property can be. And you are losing control over the management of the property and the ownership, but you are giving your children ability to get all the appreciation of this property tax-free. And this value of this property, once it's gifted to children, it's excluded from your estate, but the amount is not a fair market value of the property today, is discounted. So it's a very neat way to battle estate taxes, and it's not very complicated. For instance, family limited partnerships that people establish, you can put real estate into family limited partnerships, but it's a very cumbersome to manage. You have to set a separate accounts. You have to make sure that you have all the operations and management, and you keep in track of your books of each property. You need to make sure you file tax returns for your family limited partnership. There is an advantage of it, but it's very accounting heavy. So you need to find a strategy that would work for you to reduce the taxes if that's an issue, and also decide when to employ the strategy. Maybe it's too late or too early. If it's too late, then don't bother. Why do you have to do that? But if it's too early, means that maybe you're not subject to estate tax, then you need to wait and see. So it's a very analytically heavy work that needs to be done by the advisor who is familiar with the issue, to see what strategy might work for you with least amount of money that you have to spend and least amount of hustle. Okay. Any other questions? No.
I don't see any.
You don't. Okay, thank you. So I would like to summarize that estate planning is something that you don't just do and you forget. Usually you need to revisit it every 5 years, because we are getting into a sunset in about a year and 3 months or 4 months. There's something just as a food for thought to talk to your advisor, talk to your estate attorney to see if there is anything you can do. The easiest thing to do, and it doesn't carry any drawbacks, is to make a contribution into 529 plans, and also using your gift of $18,000 to make that contribution. It will never go to waste, because right now there is a new addition to the law saying that if you overfund your 529, and you've been holding on to this account for 10, 15 years, you can actually move some of that money into your beneficiary Roth account, and your grandchild or child can have their own Roth account without even making any income at that time. So it's a very neat process. It's something that a lot of people can do, and it doesn't carry a cost, and then it's not very time consuming. So that's probably it for today. If there is any questions or some clarifications that needed on the legislation, please let me know. Oh, there is one question came in. Is disclaiming assets at death and moving to irrevocable trust a strategy to avoid estate taxes for larger estates? Great question. Again, the answer is no. I wish. When you're disclaiming assets, you're basically saying that they will be moving either into a survivor trust, or they will be moving, depending on what you're disclaiming. But disclaiming just basically saying we're changing the ownership, who is going to own this asset, but it does not help you with estate tax. Absolutely not. Because disclaiming is not shifting the ownership from, it's still staying within the family, right? As long as it stays within the family, you have control over it. It doesn't help. Disclaiming property at death, it's too late to do estate planning. Estate planning needs to be done while you're around, and preferably at least 5 to 10 years before client goes. Otherwise, it makes no sense, because when we remove the ownership of the asset from our hands, at that time and that moment, all appreciation going forward is out of your estate, and this is what we're trying to do. All the strategies boils down to removing asset from your ownership, meaning it's going into some sort of irrevocable vehicle. Number one. Number two is utilizing other estate vehicles that I mentioned to reduce your estate valuation. For instance, if you put money or you put property in family limited partnership, that property no longer evaluated at the fair market value. It's evaluated with a significant discount, which means you just reduced the estate right there, saying that this house is not worth $10 million anymore. It's worth 7. There is a reasons why it's done that way, right? But that's the way. The idea behind changing control over your asset, that will give you opportunity to grow your asset outside of your estate, and also have a discounted valuation on your asset for certain assets. It's not going to work for every single time, but like family limited partnership has that ability. Qport has that ability. So
I have a question, Larysa.
sure.
Roth IRA funds can be used for education, is that right? Without paying a penalty?
Roth IRA? Yes, as long as you establish your Roth account at least for 5 years. And right, so once you establish your Roth account for 5 years, by the way, it's the first Roth account you ever established. It doesn't need to be, let's say you open 2 Roth accounts. One you opened in the 1990s and another you open today. It's the first account. So once it's open for 5 years, the first Roth account, after that, you can use it for education. But remember, if you're not 59 and a half and you take money out of Roth, everything that you take, that's the principal, means whatever you put in originally is tax-free after 5 years. But if it is earnings and you're not 59 and a half, you have to pay income tax on earnings and also penalty. So attaching your Roth accounts for 529 purposes only makes sense after 59 and a half. And people do it a lot because you take this money tax-free, right? So it's not affecting your income tax bracket. But I have a better idea. When my clients ask me, how do I fund 529? How do I fund education? Do I take money from my retirement assets? Do I tap into Roth? What do I do? My first suggestion is, if we're having this conversation, how do we put kids through college or grandkids through college? This conversation has to happen when the child is 10 years old or younger. Then we have enough time to develop the 529 plan, right? So we don't have to worry about taking money from retirement assets. But let's say that didn't happen. let's say, unfortunately, where we are at, and it costing $50,000 to put kids through school, and we have no 529 accounts. Then we will see what other assets we have outside of the retirement accounts. Maybe we have a non-retirement account. Maybe we have an inheritance account. Maybe we have a trust account. Maybe we have income from real estate. I discourage my clients to tap into retirement accounts till they're at least 65. Because retirement accounts, especially Roth, carry tremendous benefit to you as a retiree. That money there fully tax-free and they grow. Remember this chart showing that if your asset grow at 5% rate of return, it's a money market rate today. Your money will double in 14 years. So if you retire at age of 60, by age of 75, your $200,000 Roth is now worth 400. What does this Roth can do to you at 400,000 level at age of 75? That Roth can get you tax-free income when you need it for medical care, for emergency, for somebody come and take care of you later age, and it does not affect your tax bracket. So Roth account is excellent account to tap into for medical needs because it doesn't affect and doesn't grow your income tax numbers. But if you're thinking about college, I would rather use other assets, preferably non-retirement, right? For that. But if you don't have those, then the second choice would be yes, then we'll tap into retirement. So there is, we call it asset location, depends what the assets are, they have their own purpose. And each purpose related to what the value you have and what retirement income you have in order to utilize these assets. So the decision about 529, not 529, decision about taking money from retirement accounts come from your income needs today, but also income needs in the future. So that's a very long, answer, but I was trying to explain, how we approach it, how we look at it. We look at it as the whole, and also expand it over 5-10 year time horizon to see what's the best account to use for college.
Okay, thank you. That was a really excellent answer. Thanks.
It's a long answer, but I think I've done it because I wanted you to see the whole picture.
Okay, great. Any other questions? Okay, well, I don't see anything. So I guess we'll wrap it up. Thank you so much, Larysa.
Thank you very much, everybody. Thank you, Lisa, for organizing it. I appreciate it. Have a good evening, everyone.
All right.
Thank you for
Thank
joining.
you.